SaferWatch and law enforcement. SaferWatch is a powerful tool that enhances public safety by improving communication between law enforcement and the community it serves. Through the SaferWatch platform, agencies can send real-time emergency and non-emergency alerts, keeping residents and visitors informed about critical incidents, safety advisories, and community updates. Additionally, SaferWatch allows the public to report crime tips, suspicious activities, and threats, providing law enforcement with valuable intelligence. SaferWatch tips have led to the prevention of school shootings, stopped sexual predators, caught wanted fugitives and burglary suspects, and has even prevented suicides. This easy-to-use two-way communication tool ensures faster response times and helps protect the community proactively. By empowering both citizens and law enforcement, SaferWatch fosters a safer, more connected community. For more information, visit SaferWatchApp.com or download the free SaferWatch app on iOS or Android. Welcome to The Tactical Pause, the official podcast of the Florida Deputy Sheriff's Association. I'm John Creamer, Deputy Executive Director of FDSA. Each episode, I sit down with law enforcement thought leaders to tackle critical issues shaping the future of public safety. Together, we'll explore key topics that empower law enforcement professionals to navigate challenges, lead with confidence, and advance their careers. Take a pause, gain valuable insights, and lead your career with purpose. Thanks for listening. And today, I'm delighted to bring on Lieutenant Robbie Robinson of the St. Johns County Sheriff's Office. Robbie, thank you for coming on the show today. I know you have a lot going on, and I appreciate you being here.
It's my pleasure. Thank you for having me.
So for our listeners, I met Robbie, almost a year ago through some mutual contacts. And as you know, the world of law enforcement, especially in Florida, is very small, and we cross paths with one another. But Robbie came highly recommended to talk about financial survival for law enforcement officers. And what most people don't know is that a lot of cops are not good with money, and a lot of first responders are not good with money. We're focused on the here and the now, not the future. And it's just part of being a type A adrenaline junkie. But a lot of, Robbie, what you teach and what you're going to talk about today is things that really could help all of us when we started, had we slowed down and listened. But anyway, so Robbie has been with the St. Johns County Sheriff's Office for more than 30 years. St. Johns County is over Northeast Florida, just below Jacksonville, Florida. Robbie's not just a police officer, a deputy sheriff that knows about money. He's the real deal. He's spent years on patrol and within specialized units, like the dive team. He was a SWAT team operator. He's managed critical incidents, criminal investigations, youth resources, and internal affairs. And Robbie just has a wealth of information. So again, Robbie, thanks for coming on board. And I'd like to tell you that I saw your sheriff over the weekend, and he just bragged about your excellence in this field. So let's just get right into it. What brought you over into the financial realm? I mean, what is this? Was this a hobby? Was it something that was taught to you as a child, or how did you go down this path?
Well, it's a unique path that I took. When I came out of high school, I was going into construction. I worked construction, had my own construction business, doing some side jobs and such. So I thought I was going to go into contracting. And I met a man, my mentor. In fact, I just met with him yesterday for breakfast, who changed my life. He came from a construction background. He got involved in finance, and he started telling me about compound interest and showing me these concepts, and it intrigued me. And so the first thing he taught me, though, the most important thing he taught me, when he told me about investing and all that, was I needed to invest in myself first. You need to improve yourself. You need to read. In fact, the first book he recommended and gave to me was Dale Carnegie's How to Win Friends and Influence People. And the second one was actually Donald Trump's The Art of the Deal back in early 1990. But that was the first thing he did. He invested in me and told me to invest in myself. And then next thing I know, he's helping me get my securities license and investment license. And it just grew on me, and I became intrigued with it. And then I got into law enforcement, had another subject who steered me on the path of law enforcement, and I carried over. And as I got into law enforcement, I saw people weren't retiring well after I was in it for several years. And I said, well, I need to make my voice heard again. And as you know about money, people don't really listen. A lot of times they hear it, but they don't do it. And so I just kind of decided, I'm just not going to talk about it anymore. I'll get mine. They can get theirs. They can figure it out. But after about 10 years, John, I started seeing people I worked with who had been around for 20 or 30 years before I got hired. and they weren't retiring well. I think this pension becomes very dangerous. It's a false sense of security for us as law enforcement because we think our retirement is taken care of. We think we can retire on 75% of our pay, and we realize when we retire, well, we're not actually getting 75% of our pay. And then we have to pay insurance, and we're in more debt than we were when we started. We buy the retirement vehicle and the retirement trucks and the RVs and all that before we retire and refinance our homes. And then, so I started talking about it again, and I went to the FLA, Florida Leadership Academy, and I attended that, had to do a research paper, and I did the research paper on the need for financial literacy in law enforcement. And the response from the class was just so overwhelming. The comments and all, when it went back to Tallahassee, they called me and said, everybody needs to hear this. This needs to be part of the Florida Leadership Academy. And they asked me to put together an agenda. And that's kind of how I got started doing that. And it just grew from there.
Yeah, Terry's the one that mentioned you to me. We were doing another training class down in Marion County about artificial intelligence and emerging technologies. And at the end of the class, she's like, you have got to meet this lieutenant from St. Johns County. This is something that everybody needs to hear about. So you've definitely made your mark.
Yeah, it's something everybody wants to hear about money, and it's something that everybody's interested in. And we'll talk a little bit more later about the connections and all, but it's 70% of our stress comes from money. And if you look at the top research or the top Googled subjects every year, it has to do with finances and money. And so everybody is concerned about money. Everybody wants to hear about it. What a lot of people don't want to hear is the sacrifice and discipline they have to do to get to where they want to be. And, that's what I think what I do is I bring a perspective because I'm in law enforcement, understand the nuances. I've been doing it for a while, and it's unique, as first responders of what we do and what we have as far as a pension. And so I think I bring a perspective of how money actually works. It's not about just how much you can afford to make the payments on each month, but what is that actually costing us? What are we spending and what are we not getting when we don't start investing early?
Exactly. And Robbie, for our listeners too, not only are you a law enforcement officer, but you're a leader in your agency, you're a lieutenant, you're a leader in your church. And I think this is also part of your ministry. I know that from talking to you and seeing you present. I know how passionate you are about this because you're right. Just the stress level that first responders, whether they're telecommunicators or detectives or patrol or firefighters, are in this huge pressure chamber for their whole shift. And you're right. And you throw in the money, stress that goes with it. It can really tear somebody down.
Yeah, absolutely. And, some of the things I've read and surveys I've read about money and how it affects us, our health, our performance at work. There was 85%, I forget what survey it was, but they asked the supervisors, have you ever seen an employee or experienced an employee whose job performance was affected by their financial issues? And almost 85% of them said yes. And then they asked the employees who work with their coworkers, have you ever experienced or seen one of your coworkers have their job performance? And as it was about the same number, around 85% said yes. And if you look at the Safe Leo, suicide awareness for law enforcement, they'll tell you they do a survey or pull up a survey every year from the American Psychological Association, and the number one issue of anxiety every year is money. And there's a huge connection, a big impact and connection between suicide and finances. If you look at anybody that's ever investigated those suicides, there's always some kind of nexus there to their finances, usually, that has to do with that.
Okay, so for you and our listeners right there, Robbie, that's one of the main reasons I brought you on too, is because we do a lot about wellness and resiliency, and what you talked about in the beginning, that people were not retiring well. And our goal here with the Florida Deputy Sheriff's Association is for you to retire strong and finish strong. So this is fantastic. So let's start. If I was a brand new deputy, or you're talking to a group of brand new employees, what are some of the first things that you would drop at their feet? What were some of the first ideas or suggestions you would give them?
Well, I think the first thing I do, and I teach our new hires when they come in to our classes, and just understanding how money works. I don't think they understand the power of compound interest. And if they start early and start investing, The first thing I would tell them, don't go down there and buy the big jacked up fancy truck and the jet skis and all those toys that we like to get as first responders when we first start and get our first job, especially when we're single and maybe even living at home. But the people that I've seen who have been successful, John, there's usually a commonality, and that is one person, a supervisor or a lieutenant or someone, came to them right away and said, you need to start doing this. Usually they made them do it. They filled out the paperwork and said, you need to start investing in your 457 plan and have money come out of your paycheck. And that was usually from experience because they didn't do it and they realized they should have. And so that's the commonality. And then the other one is they stuck with it. They were consistent and they continue to do it and they continue to invest in it. So that's what I would tell people is coming in, get started right now. Don't start thinking about retirement now. Don't think that your retirement's taken care of just because you have a pension, because the danger of it is there's no guarantee you're going to make it 25 or 30 years. Anything can happen in our lives. And if that's what you're basing your retirement on, then what are your options and what are your margins? What are you planning for contingencies?
So that right there in and of itself could be a podcast, right? For me, I started back in the early 90s and my pay was $12.83 an hour. And I thought I was just walking in high cotton. And I went out and I bought a brand new truck. And then the insurance went up and all these other things. And then all of a sudden I was working off duty to pay for it. And then I had to work off duty to pay for it. And then came along an injury in the line of duty injury where I was out for months with knee surgery. And it was, to what we talked about a few minutes ago, it was so stressful trying to make the payments for that vehicle. And that's when I learned the hard way that was a really stupid decision. So you see that a lot, right? I mean, that's sometimes par for the course with a new person coming on and first time they have a real job with real income.
Yeah, you see them come in and let's just throw a number out there. They're making $50,000 a year starting. You and I started. I'm like you. I was making $12,000 a year working construction in 19 when I started in law enforcement. So my pay almost doubled for me. And that was big money. But we get started, and all of a sudden we want something more. We want a bigger truck, a nicer house. So all we got to do is just work one off-duty job a month, and we can make that extra payment. And the next thing you know, maybe it's a motorcycle or whatever it may be, and just one more off-duty job, and pretty soon you're making $50,000 a year, but you're spending $60,000 a year, and you're depending on $1,000 a month or whatever coming in from off-duty and overtime, and then you get stuck. Because you have to work, like you said, you have to work that, and that gets stressful. After a while, after 6 or 7 years, you've put yourself in a situation where you got to get rid of stuff. Or, as Warren Buffett says, the more stuff that you buy that you don't need, eventually you'll have to sell stuff you do need to get by.
That's good. That's good. So let's jump in. Where would you want to lead this discussion? So, I mean, I just disclosed that was one of the mistakes I made right out of the gate, and then I did the same thing when kids came along. Is I signed up for more off-duty jobs to pay for diapers and formula. But what we're talking about, your financial survival for law enforcement, is way more than that. It's we talked about your presentation. You talk about insurance and interest, things like that. So let's get into it. What would you have to say?
Well, the first thing is understanding just how money works, and get away from this mindset of, can I afford the payments? How much does it cost a month? And that's something that the financial institutions and our generations before us, our grandparents and great grandparents, have instilled into our minds. Investing's bad. It's not safe. You can lose money. That comes from the Great Depression, from our great grandparents, and that's been instilled. If you look at the track record of the investment market out there, is not true, and it's been positive. But I think understanding that, and then the other side is compound interest works for us when you're investing, but it works the same way against you when you're paying it. And when we understand that and we can see it, it has a huge impact on the way we think about money. So if all you care about is how much the monthly payment is and whether you can afford it, well, they've got a payment plan for you. No matter how much you want to spend a month, they can make it work for you. It's how long you're going to be paying for it and how much are you going to pay is the key to that. And I'll give you an example on compound interest. You have a $3,000 credit card. The average interest rate out there on credit card is 21%. If you just make the minimum payment or pay $60 a month on that, it's going to take you almost 10 years to pay that off if you have no new charges. and you're going to pay over $4,000 in interest on a $3,000 balance, assuming you make no more charges on it. Versus you invest $250 a month for your average 40-year working lifespan from age 25 to age 65. You've got $1.6 million out there at 10% in an S&P 500 mutual fund. So I think understanding that impact and how much you've only invested about $150,000, but now you've got $1.5 million. And I think understanding that impact of that compound interest is what I'd want to start off with someone understanding how money works.
A couple things. Yes, to your point, growing up, my parents were born in the 40s, and a lot of the Great Depression and things from the World War II rubbed off on them. And it was how much down, how much a month was really the only concern. How much down, how much a month. And that's a huge fallacy, And then secondly, you told a story the last time I saw you. We were presenting there at your agency, and you talked about that new Bass Pro Shop right down the street. And you were looking at a new boat or a new camper. Tell our listeners about that. So if you went in there and you bought something, what's the real price of when you do that and when you finance?
So the story I tell is, looking at this bass boat, and it's it's $440 a month is a payment. It's in like 8-inch high letters on there. They sell you on the payment walking in, and I'm sitting there thinking this is $60,000 bass boat and $440 a month. I said that's pretty good. I could drive out of here with that today. But then it dawned on me, a $40,000 truck is like $700 a month, and how can they have that kind of payment? So I got a little closer to the fine print and started reading it and realized that this thing, the financing terms they had were for 20 years. 20 years for this bass boat, and that was the first time I realized you could finance a boat for 20 years. I thought you could do it for 10 years. I did not realize. I always figured it was 5 years. But then I did some more math. I said, well, $440 a month times, 240 for 20 years comes out to like $112,000 on a $60,000 boat. And, that was just eye-opening that if we just look for the payment, you can get whatever payment you want, but how much are you going to pay, and how much is that boat going to be worth in 20 years?
Right. Yeah. So long term, you've paid double and triple for something that no longer has value by the time you pay it off, if it's still even operational.
Yeah. I mean, we all know those motors are about $20,000 a piece, and you're going to have to repower that thing at some time if you're scooting 80 miles an hour across the lake fishing and doing whatever you're doing. But yeah, they get expensive. The maintenance on them, just taking them in for service alone is $1,000 to get oil changes and just your regular maintenance you need to get done for warranty work. So just getting people to think that yes, it's nice having that boat, that nice new car. It's exciting that first few months, but after you start making those payments for a while, then especially when they go out of warranty and you have to start repairing them, they're not so much fun anymore. Now they're sitting in your garage depreciating, but you're still paying on it.
Right. Yeah, I've been there. A long time ago, I was there. So what else? So again, in our presentation, in your presentation, we talked some about compound interest. We've talked about what it's like to get it underwater really quick, financing something. But how about with FRS? What are some of the things you would tell somebody about FRS that's just getting into it, or somebody that's in FRS right now? What are some hacks they could do to make their retirement better?
So that's a great question. The FRS, first of all, don't just sign up. This is what I see a lot of people do. They come into their careers and then they don't even think about retirement or look at their pension again until they're 55 or they've got 25 years in, they're going in a drop or whatever it may be. All they remember is they told me I was going to get 75% of my pay, and they don't really look at what it's going to cost. They don't look at what insurance is going to cost, when they retire before age 65. The thing I would tell people to do is look at it, pay attention to it, understand exactly what you're going to get. There's 4 options, but if you're married, you're going to go to option 3. If you go to option 3, you're not going to get 75% of your pay. It's probably going to be somewhere above 65% because they give you less the longer they guarantee a payout to your spouse. They're going to give you less money. And so, and then, the insurance, how much is insurance going to cost? And I would tell people to be doing that now. Look at it now. Go to those seminars. I don't care if it says, the seminars, they label them like, if you're getting close to retirement, for the FRS, go to them now. Understand how that works and the nuances, and prepare for it and, get ahead of the game. But the hacks I would tell you with the FRS has a great website with a lot of resources. And, My FRS, all you have to do is log into My FRS. You don't have to log in. You can just Google My FRS, come up to the home page, and you can scroll down to the bottom where it says resources and calculators. And there's about 50 different calculators, anything from, looking at how quick your money will grow at different interest rates, withdrawal rates. You can look at mortgages. You can figure out how quickly you can pay down your mortgage, how much you can afford, all these things. There's all kind of calculations in there. But one of the best ones in there you can use is called the Snowball for debt. And it's a snowball calculator, and you can plug your debt in and see how long it would take you to pay that off. And most people can pay off all their debt except their mortgage in about 2 years by following that simple snowball plan, spending the same money they're spending, not spending any more, and then paying it off. So these are the hacks that I would tell people to take advantage of that. Also, the advisement on there. They have Ernest & Young. That's probably this is the auditing company, the accounting company that does Amazon. So this is a huge company that we're privileged to have for free as part of the FRS that we can use and take advantage of those resources. You don't even have to log in. You need to get a PIN number to set up your account. If you haven't done that, I recommend it. But just use the resources they have on the homepage, and anybody can use it. You don't have to be a member of FRS to go to their homepage and use those calculators.
See, that right there is worth the price of admission, right? And I should have told our listeners, if you're not from Florida or you're not a part of the state retirement system, FRS is the Florida retirement system. And almost every single sheriff's employee across the state is in FRS, and many smaller municipalities also contribute to FRS. And Robbie, you're right. I mean, every time I'm looking at the webpage right now, that's why I got more excited. I don't have to log in, and I've never noticed this, but this is loaded with resources from new hires to retirees and everywhere in between. And you're right, the snowball plan is here. I never looked at this. I always just went straight to the login page to go see where I was at.
Yeah, it's a ton of resources. Like I said, again, the great thing about it is you don't have to be a member. Anybody can use those resources on there in those calculators.
Yeah. And to your point, going back to the option 3, so it's hard for a young employee who's maybe 21 or 22 years old to think about 30 years down the line and think about what a spouse might get during retirement or during death when you're not even in a relationship at the time. So how do we start changing the minds? I mean, you're doing that at your agency. You're coming in speaking to all new hires. But is there something we could do as an association, or are there some resources that we could send out or post on our webpage to start bringing more awareness?
Well, it just comes down to human nature, John. Not everybody's going to listen. It's just continuing to talk about it. I think having the senior people who have been there, who didn't think about it, like you and I, when we were 21 years old, and now we realize we probably should have thought about it a little bit more, using those experiences, telling our stories, and not being afraid to be vulnerable when we talk about the mistakes we made. And I think that's probably the biggest influence, because those first line supervisors have the most influence on these young deputies and young people coming in. So I think just telling those stories and, hey, this is what I did. We were all young. We know everything. We're not going to listen to everything. But if we keep putting that message out there, some are going to listen, most won't, but eventually it will stick in. It takes about 6 to 8 times for somebody to hear something before they finally actually get it. And so I think just continuing to put that message out there, reminding them of the resources. I know our sheriff's office and our sheriff does a great job of providing financial advisors that come in for free, and they set up appointments and people can go see them and talk about whatever they want to talk about, in their finances. Having somebody come in and speak about financial literacy, teaching them about how money works is important. Don't have the guy or the gal who's running your 457 plan do that. They have one focus, and they're not going to give you advisement on the funds and what to put into and, how money works and debt and all that kind of stuff. Get an actual somebody in there that can come in and talk and actually advise somebody and show them how money actually works.
Yeah, they need to make it cop-proof, right? And I can say that because I am one. They need to make something, especially as nebulous and scary as money, the presentation needs to be cop proof, which is why you've presented for us 3 times and they're almost always full. And I think you do a wonderful job of doing that. What's the difference? We talked about FRS and the pension plan. What's the difference between the pension plan and the investment plan?
So with the investment option, right now you have money being contributed from your employer into the FRS for your pension, and a percentage, comes out of your pay. 3% goes in, but all of that goes into the pension plan if you choose the pension. And at the end, they guarantee you, or a certain amount every month, and then when you die, that's it. Or when you and your spouse die, if you choose option 3, well, that's the end of that payment. With the investment option, you have the option of having that money going into an actual investment where you can choose funds and mutual funds, and it's kind of scary for some people because they don't understand that, and that's why I say the first thing you need to do is, like my mentor told me, is invest in yourself. Look up this stuff yourself. Get the information so you understand it. Most people would come out ahead, especially those who are in the regular class. I'll tell you that much right now. If someone's in regular class, they would be much better off in most cases to probably look at the investment option, because they're going to get less than 50% of their pay, when they retire. And if they invested that money, they ran the numbers, they ran the figures, they would probably have a better chance. The difference is you now have to manage that money yourself. And when you retire, you also have to manage your withdrawals. And you can't go in there and just take $1 million and go on a spending spree. When you retire, then it's going to be gone. And that's probably where the fallacy comes in. We're not good at that. And we don't manage money well. So when we retire, if we have a big lump sum, just like the drop, most people blow through their drop money in about 2 to 3 years. They've got $200,000 or $300,000 and it's gone in 2 or 3 years because we've gotten this big lump sum of money. So your behaviors that you develop now are the same behaviors you're going to take with you into retirement. And if you don't develop, it doesn't mean you can't develop those habits. But most people, the safer bet is probably going to be the pension because of what I just said. But for those who can invest well and have discipline, the investment option is gives you more money. It gives you more opportunity to do more with your money and have different options, to leave money behind, to give, to whatever you want to do. You have options. You're not just waiting on a paycheck to come in once a month until you die.
I got you. It gives you more freedom, and your money works harder for you, and you have more options. Yeah. And like you said, with FRS, when you're gone and your spouse is gone, the money ends. Whereas in the investment plan, it could live on, and you could pass it on even generationally, right? Yeah. But
I would say, get competent financial. Everybody's financial situation is different. Use those sources on MyFRS that you have with Ernst & Young. Talk to an advisor or a senior advisor, and get different opinions on that, because everybody is different, and what works for one may not work for the other. An investment option isn't for everyone, but you just have to understand the differences between them in your own tolerance.
Okay. You talked about too in the past that banks, kind of changing gears, but banks are not your friend. Tell me more about that.
Well, the banks are built on a system of, they're in the business of making money. And so you put your money in there, they give you guarantees, whether it's a savings account or a CD, and they're going to give you 1 or 2 or 3% on your money. But I think what most people don't understand is what they're actually doing with that money. How are they guaranteeing you 2 or 3%? Well, that money doesn't just go in there and sit in a safe somewhere in their vault when you give them that money and they guarantee you 3%. They're reinvesting that money. One of the ways they're making money on that is they're loaning it out. So you put $10,000 in a CD in a bank somewhere or in a savings account at 2%, then you get a car loan from that bank. They just loaned your money back to you at 7 or 8%, and all your friends' money that's in there. Same thing, with the mortgages and all. They're also reinvesting that money. They're putting that money back into the economy. They're out there getting the 12, 16, 8% real estate, whatever it may be. They're reinvesting that money in the economy, in the mutual funds and investments. By the way, the pension is too. We think our pension is guaranteed, but it's also based on the economy. So we saw what happened after the 2008, 2009 recession. We saw what happened to our retirement plan. We thought it was guaranteed. Well, what did they do? They reduced our contributions. They made us contribute more money out of our pocket to it, and they also took the cost of living, away. So there's some of that's been restored, but if you think it can't be changed, well, it can be, and it was based on the economy.
And we'll be right back. Every day you put your life on the line to protect and serve. Who's protecting you? United Badges Insurance Services operates as a dedicated resource for the first responder public safety community. Serving thousands of first responders, United Badges offers a wide range of products including commercial insurance, group accident and health insurance, and personal insurance such as auto, home, renters, rental properties, vacation properties, boat, motorcycle, RVs, flood, and umbrella. United Badges serves active and retired public safety personnel, public safety agencies, public safety associations, public safety support businesses, and public safety families and friends. Experience the United Badges difference. Call 800-566-5990 or visit unitedbadges.com to request your free insurance quote today. United Badges Insurance Services is a proud strategic partner of the Florida Deputy Sheriff's Association. Applicants are individually underwritten by each respective insurance carrier and subject to insurance policy terms and conditions. Not available in all states. Promotional material for descriptive purposes only. Now back to the show.
I see. So, for me, going back to this really old movie, I'm dating myself, It's a Wonderful Life. So the banks are not like George Bailey's bank back then, where they would give you their last dollar to help you out. The Bailey Building and Loan. It's not like that anymore. It's commercialized, and they're using your money to make their money, correct?
That's exactly correct. And they want you to get in debt. And the more debt you get into, that's why they keep upping your limits on your credit cards, and they keep trying to get you to refinance. And the more debt you get into, the harder it gets to make the payments. The harder it is to make the payments, the more likely you are to have a late payment. You get a late payment, they charge you a fee. You get a late payment on your credit card, they not only charge you a fee, they raise your interest rate, and they compound interest on top of that. And if you look at the credit card industry out there, they're making over $100 billion a year in just interest alone. So they have a lot of reasons not to be your friend. Yes, they may come in and talk nice and all, but you should never allow a bank to tell you what you can afford. And I think that's a problem that we have as we go in there thinking, like buying a house, for example. We think we can afford a certain house and a certain payment. We sit down with a bank and they use this debt to income formula, and they don't really consider you got diapers to buy and all that stuff. They don't care. They just use a formula, and they say, well, you actually can afford a $500,000 home, mortgage on a $500,000 home. So what do? Well, we go home and we get with a spouse and we start looking at bigger homes because the bank said we could afford it. Well, the bank wants to sell you the biggest loan they can because they get the biggest closing costs and the biggest interest rate off of that. So be careful listening to a bank give you financial advice. It's a great place to save money short term for emergencies and savings and things like that. If you want to put your money there, I think money market accounts probably will give you a better return. Money market accounts at a bank are probably not going to pay you much, but some of these online platforms that are out there pay 4% or more on these money market accounts, and the bank is only going to give you a fraction of that.
So speaking of banks, what's the difference between a bank and a credit union, and which one is more, if there is one, that's more in line with with helping you be successful?
Well, I don't know if any of them are in line with helping you be successful. They're great tools. The difference with a credit union is they're nonprofit, so you're likely to get better rates with them because they work for you more so. That's a right way to do it than a regular bank like Bank of America or whatever. I don't want to name banks or be disparaging towards anyone in general, but the credit unions are nonprofit, so you usually get a better rate. They're working for you, and they're working to make you money, but you're still going to be in the same situation. They're there to make money off these loans and off these closing costs, but credit unions usually will be better than a regular bank.
Okay. So just kind of summing up where we've gone so far is, we've talked about some of the mistakes we've all made as rookies or as new hires when you finally get some money in your pocket and how it seems to burn a hole through it. And we've touched on the Florida retirement system and some of the concepts that we should and shouldn't do with that. And then I think it was really important. All of this is really important, but the concept too about banks and credit cards that you've touched on is really important because the credit card debt, how many do you have off the top of your head? How many Americans or in credit card debt, and to what tune? Do you have any idea?
Not off the top of my head, but it's high, and it gets higher every year. I think we're over. I think we just passed a record, and every year we pass a new record. We're at, I think, somewhere around $1.2 trillion in credit card debt right now in America, and that's huge. We were at $1 trillion a couple of years ago. Part of that, John, is with the economy and everything and inflation, people are using credit cards. Our wages aren't going up to keep up with the inflation that's taken place, the last few years, and even after COVID. And if you look at, I think at one point it was $6,000. It was costing us $6,000 more on average to live the same lifestyle. Yet our wages weren't going up. So what people were doing was instead of adjusting their budgets and their spending, they wanted to maintain their lifestyle. So they started using their credit cards to make up that difference, and it just continued to compound. And so now we're over $1.2 trillion and paying over $100 billion in interest every year to these banks.
And going back to what you said earlier, if somebody did the snowball program, theoretically, there's a way to get out of that credit card debt as an individual just in a couple of years if you're disciplined. Is that right?
Yeah. And basically, it's pretty simple. You pick out your lowest balance, whatever credit card you have your lowest balance on, and let's say you're paying $2,000 a month in your debt. Well, instead of paying off that credit card, say you're paying $200 a month on it, when you pay it off, instead of buying something else or spending that money on something else, you roll it into the next card. You basically double your payments up on the next card, and you continue doing that. You do it to your car payments and so on. So you pay this thing off in roughly 2 years or so on average, depending on how much debt you have. Now, if you have $100,000 in student loan, that's probably not going to work, but you can pay off all your revolving debt and get it knocked out without spending a dime more than what you're already spending.
Which would be completely liberating, right? I mean, you'd be out of that burden. You wouldn't be a slave to debt if you just had the discipline.
One of the examples I used on that in my presentation is someone who's paying out, I think it's $2,200 a month or $2,700 a month, including their mortgage. They have 24 years left on their mortgage. They use a snowball, including their mortgage, and they pay their mortgage and everything off in 9 years, and not spending a dime more than what they were already spending when they started it. They pay off their normal debt in less than 2 years. They put all that money towards their mortgage. They pay it off, and they've saved hundreds of thousands of dollars in interest. And that's a whole other area we didn't touch on is the mortgage. We can talk about that if you want to also.
Yeah, actually, that's the next bullet point that I wanted to run by you. Let's talk about mortgages.
Okay, so mortgages, again, we get into this trap of how much does it cost a month, and can I afford it? And when we look at what a mortgage, one of the examples I show, and I use 5.5% because that's what it was back in the days, but it's still very powerful when you look at how much we actually spend on a mortgage. So you take a $400,000 mortgage, median home price in Florida, and at just 5.5% interest, your payment is over $2,200, almost $2,300 a month. However, only $400 and something is going towards the principal out of that when you make this payment. In fact, it takes you over 15 years and you're still not making half. The payment is still not going towards the interest. So if you put that into numbers, John, of a $400,000 mortgage, you pay on it for 5 years, you've paid in about $140,000, and I'm using 5.5% on this example. You've only knocked $30,000 off the principal. You still owe $370,000. After 10 years, you've paid in nearly $300,000, but you still owe $330,000 on your mortgage. And after 15 years, you have paid for that house, but you still owe in payments. You've paid over $400,000 in payments, but you still owe nearly $300,000 on that mortgage. So in the end, you've paid double for that house. You paid almost $1 million for that home. If you refinance it at any time, you start all over again. And then you pay closing costs. One of the examples I use, if you pay on that house for 15 years, for 5 years, you've paid in, $140,000 roughly. You still owe about $370,000 on it. Now you have closing costs when you refinance. That closing cost gets rolled back in there. Say it's $15,000. Now your balance is $385,000. If you're making that payment for 30 years again, your payment $400 in principal is all that's going towards the principal. It's going to take you 3 years just to pay the closing costs off. So now you're 8 years into this mortgage. You're $200,000 in payments, and you still owe $385,000 on it. And we don't understand how devastating that is to us. How much money we pay in these mortgage payments alone. When we refinance, just trying to get a lower payment, or whatever we do. If all we care about is a lower payment, we're going to pay what they call the TIP, which is the total interest paid. Everybody's concerned about the APR. What the annual percentage rate is. They get all excited, waiting for interest rates to come down. You're going to pay 125%. That's really a farce to pay attention to the interest rate, because that just affects your interest, your payment, your monthly payment. That's your here and now. What you're going to pay in the end is 125 to 130% in total interest on that. You'll pay for that house twice, and if you refinance it, you'll pay for it even more.
That's staggering. I mean, and that's why I think a lot of times when we're, as adults, when we're scared of something, we don't want to peek behind the curtain, right? It's that way with some technology. It's that way with money and some other things. But is there ever a time, in your opinion, that it would be safe or smart or prudent to refinance a home?
Yes. If you refinance it, say the interest rates did go down and you owe 25 years or something on your home, and you're able to refinance that thing for 15 years for a lower term, you're probably looking at $100,000 or so in interest you could save. But yeah, if you refinance for a lower term, even if you refinance it for 20 years, you have to run the numbers on this. And I said, I can't give everybody financial advice on this. So these are things to consider and look at. Don't just go in there and look at what the payment is. See how much money you'll save, how much quicker you could pay it off, but refinance it for a lower term. Don't go roll your debt over into the equity. And we build equity in our homes fairly quickly, especially here in Florida. Our home value goes up, and then we think we're going to roll our car and our credit cards and all our debt in there. Now you're going to be paying on that for another 30 years. You could have that car paid off in 4 years. Now you're going to be paying on it for 30 years, even after it's long gone, and you don't have it anymore. You're still making payments on that car and on that credit card debt and that vacation you took. So, I would say use a snowball plan. Come up with a plan to pay off that debt. Don't roll that into your house just to get a lower payment on it.
And Robbie, what are the different types of mortgages? I mean, there used to be, or I guess there still is, the ARM, and what are the other things that are out there?
Yeah, your home equity, your HELOCs, your home equity lines of credit, your adjustable rate mortgages. And here's where a lot of people have gotten in trouble over the years is they can't afford the down payment. And first of all, it's a myth that you have to come up with 20% down on a home. And a lot of people think you have to have 20% to buy a home, and you don't. There's plenty of programs out there to be able to get a home. The key is to buy a home that you can afford. And my mentor told me many years ago, he said, if you can't afford the payments on a car to pay it off in 3 years, you probably shouldn't buy it. It's more car than you should buy. And the same thing goes for a home. If you can't afford the payments on a 15-year mortgage, it's probably more home than you can afford. And it's good advice. It's kind of hard with today's market and the home prices here in Florida. But the earlier you can pay that off, if you could refinance it and save interest, you have to run the numbers with the closing costs and everything. But if you can save money, refinance it for a lesser term, not a longer term. If you have 25 years left on and refinance it again for 30 years, you're not doing any good. But if you can do it for a lesser term, there are times when it would be beneficial.
Okay. See, I'm glad you said that, because so if you're going from like a traditional 30-year loan and now you can refinance it for a 15-year loan and pay the note off sooner, that in the long run, that's better, right?
Yes, absolutely. And let me go back and answer your question about the adjustable rate mortgages and the different types of mortgages. I've seen a lot of people do is get into trouble. They go in and the banks and the finance companies will offer them, they can't afford the down payment, or they can't afford the payment and the interest rates and all. So what they do is they sell them an adjustable rate mortgage, for the down payment. And then they do a regular mortgage on the rest of it. So now they've got two mortgages. And this adjustable rate mortgages, they come due, say it's a 5-year adjustable rate mortgage. So in 5 years, that adjustable rate mortgage, you're going to be locked into a lower interest rate, but then it's going to go up. And you're going to have a higher payment. And you have to make a choice. When that payment comes due, do I refinance this again into my house, which is what they're counting on? You just start over again. But we get caught in these traps. And these HELOCs, these home equity lines of credit, those are interest only usually. So you pay on this thing for 20 years, and you've done nothing but pay interest on it. You take out a $100,000 loan, put in a pool, whatever it may be, pay off debt. And then at the end of 20 years or 10 years, whatever it may be, you still owe $100,000 because you paid nothing but interest all that time. And I don't think a lot of people realize that. They just thought they've been making payments on this thing the whole time and their balance is going down, and they didn't realize they're just paying interest this whole time.
Yeah. So, I mean, you're trapped on the wheel, on the hamster
Yeah.
wheel, right? Yeah. What about with cars or a vehicle? What are some things to avoid, or is it a similar situation, when you buy a car or a truck, or, I mean, should you finance? Is cash still king? Those things.
Yeah. So car is a little bit different. It's not quite as bad because that's usually on a fixed interest rate, but they have gotten so creative out there. People that don't have, good credit, the things they've done. First of all, we love our cars. As Americans, the cars identify us. That's who we are as Americans. You go to other countries and they're just driving, plain old regular cars, around just to get them around. But we love our cars here in America. And, it's the first thing we do when we get a job. We usually go buy a car. That's what we do. And then, start looking at houses and all. But cars are devastating to us financially. I remember my mom telling me when I was young that you're always going to have a car payment. And this is back when you used to finance them for 3 years. You should trade it in every 2 years and get a new car. So you have something reliable, still got value to trade in, and because you're always going to have a car payment. And when I started learning about money, I realized, well, you don't always have to have a car payment. If you took the money you spend on a car, average $600 a month payment, and invested that instead of buying a new car every few years, you'd have over $4 million, at age 67 by doing that. And that's a pretty expensive car. But the financing that they do out there, when we buy these cars, they lure us in with these 0% interest advertising. And you've seen the commercials, but they always say for qualified buyers only, well-qualified buyers only, and I've even seen especially well-qualified buyers only. And do you know what that means? And that's the thing. You have to have credit score of over 700, 800 sometimes to get that interest rate, but they get you in the door. And they sit you down and you drive that car. And they don't tell you that's only on select models, by the way, that they're trying to move. And you sit down, you don't want to leave. So now you go in and think you're getting 0% interest, and you leave from there with a new car, and they financed it. They gave you the payment you wanted, but now they financed it for 7 years, sometimes even 8 years on these things. And you're paying, 12% interest or 9% interest on this car. And we get ourselves into trouble. If your credit's not good, I've seen some horrible things out there, John, with my coworkers that have gone in, they wanted a car, they looked at the payment, they told them, is this payment good? And they find out a year later they've been paying 18% interest, on this car. You got a $30,000 car, they're going to pay $12,000 in interest on it. And, you just have to be careful. Don't get lured into the 0% interest and these deals out there, or the payment. Understand what you're paying and how long you're going to be paying it for.
Is there ever a time in your mind that a first responder would need to lease a car? I mean, is it better to lease or to buy a car?
John, I'll tell you right now, you should never lease a car. And some people would have disagreed and argue with me about that, but leasing a car, you at the end of that period of time, you give the car back, you've paid all the money in, you've got nothing. They're counting on you starting over again, and you can buy the car and all these things, but you'll never it'll never come out even for you. So I would say buy your car and look at reliability. We all I showed the example. I love those GMC trucks, the 4-wheel drive, off-road, AT Ford and alleys and all. They're great looking trucks and all, but I'm not going to go pay $80,000 for a truck. I've got one that costs half that. It's a Toyota Tundra that will probably last me the rest of my life. If you look at the track record of those things, they hold 65% of their value after 5 years. And same thing with Hondas and cars like that. But look at something that's going to give you reliability and it's going to last a long time, instead of something that looks good that you're probably going to trade in every 3 years. Because if you're looking for something that looks good, then after 3 years, it's not going to look good when the new models come out, and you're going to want that. And we get ourselves into those cycles. So, I would say get what you need, not what you want, and look at investing that money or putting it towards debt, and making that car last. I can tell you, that last truck I had it 17 years, and my godson is still driving that truck to Kentucky and everywhere else pulling trailers. So it's, the least amount of time I think I've owned a car is about 9 years. My wife's car, her last car that she got before we got this current one.
Yeah. All good things, Robbie. And I saved this for last, budgeting. So we know that, we work for a sheriff or a police chief. Well, the sheriff has a budget, city has a budget, McDonald's has a budget, Target has a budget. Why are we so scared as individuals to have a budget at home? And what are some misconceptions about a budget? Is it hard to start one? Is it hard to keep up with one?
It's not hard, but we have to get started. I think the hard part is getting started. I think the reason we're scared of it is because it's accountability. It causes us to be accountable. And I tell people, if you want to start a budget, the first thing you have to do is you have to know where you're at. And go pull your statements up from the last 2 months on your bank statements to see how much money you've spent and where you've spent it at. Now, the problem with that is it's just going to give you a vague figure. It will show you going to Walmart and going to Publix or going to certain place restaurants and all, but it's not going to tell you what you bought. And so I tell people the next thing you need to do simultaneously is write down what you've spent for the next 30 days. I've done this a few times throughout my life, and it's eye-opening. You how easily you can creep back in as you get raises and promotions and all into spending money. But I urge you, just if you do nothing else, go take a pad with you, however you want to do it digitally. And every time you stop at that gas station and you go in and buy a Coke, you write down where you stop, what time, what you spent on gas, what you spent on that Coke and candy bar or coffee in the morning, and keep track of it. And you're going to change your spending habits when you realize how much you're on lunch and all these little things, the coffee in the mornings, at Starbucks, all these things add up. And so the budgets are important. Like you said before, we have budgets at the sheriff's office. We don't go over to the county commissioners and go, we need $100 million, and they go, okay. They want to know exactly where that money is being spent, line item by line item. And we need to do the same thing with our own. The hard part is getting started. Once we get that budget started, then it's easy to maintain. But we have to write this stuff down and be flexible. You're going to make adjustments to it. But that's going to tell you where your money's going. More importantly, it's you telling your money where to go, and instead of it telling you where to go. And right now, most of us are allowing our money to control us. We don't have enough money, so what do? We go work more hours to make more money. And so I would say the budget is very important to control your spending and to keep track of where your money's going.
Very good. I know for me personally, it was, I was probably in my 30s before we even did a budget. And it was something that our pastor started talking about, was budgeting and how not to be a slave, to your debt. And going back to what we talked about in the beginning about mental health, marriage health, because money is the biggest factor for those things. Mm-hmm. So, hey, Robbie, in our closing few minutes, is there something that we should also share with our listeners? Is there one more thing that you could point out that's super important?
Well, I would say discipline. One of my mantras that I use in my articles and my presentation is discipline equals freedom. And I've used that. I got that from Jocko Willink in a book that he wrote called Extreme Ownership, co-authored that. And he also has wrote a book in the last couple of years called Discipline Equals Freedom. And I said that really applies to life and especially to money. Money is about freedom. The more what we're doing now is we're working for money. And I talk about somebody making $50,000 a year. They're working about 80 hours a month to take a $2,000 mortgage, and only 64 hours or so of that is actually going towards, 16 hours or so is actually going towards the principal. The rest is going towards interest. That car, you're working about 30 hours a month just to make that car payment. And if we don't have discipline, then we're going to continue to have to work for money. And at some point in time, we're going to need money to work for us, but we're not going to have it there to work for us. And money works for you 365 days out of the year, never calls in sick, never gets tired. And at some point in time, we have to have money working for us. So the question is, how much time are you willing to invest now to make money to buy more time later? When you retire, to spend time with your family and your grandkids. We put 30 years or more into this career with the shift work and everything that we do. And all we're doing is working for money. We're spending time for money, but when are we going to have money working for us so that money can buy us time? And, I'll close out with this is something that people don't think about, but we're all going to make about $2 million at least in our working lifetime. You know, the 40-year, 25 to age 65. If you just make $50,000 a year in 20 years, you made $1 million. $25,000 a year, you've made $1 million in 40 years. But you're going to make $2 million. Dual income household, you've made $3 to $4 million in your household. Yet the average household only has about $150,000 to $200,000 in the retirement savings. Where did all that money go? You know, it's why we need to be disciplined. We need to have a budget. We need to be accountable. And once we get started on that path, it becomes effortless. You know, it becomes a habit. It becomes a behavior. The same way that our behaviors now are getting us into trouble, it can get us out of trouble. It's just a matter of instilling them.
Right. Great words to close with, Robbie. Now, if one of our listeners or somebody wanted to learn more about your presentations, how could they do that?
Well, they can contact me. I think you're going to probably add a link to the website there for this, but they can reach out to me. You know, give me a call. They can call the sheriff's office here. I know our sheriff has been really good about having me go out, you know, with y'all and others. You know, I've been around the state with FDLE for the leadership academies and individual agencies. So, you know, I'm passionate about this. I'd love to come, you know, give a presentation to their agency. You know, it's important for leadership to understand that this has great impact. The financial side has great impact on their agency and on their people, but most people just don't understand it. And I'm, you know, trying to explain it in a down-to-earth tone. You know, that's important. So, yeah, if you want to get a hold of me, my email is jrobinson@sjso.org, the letter J. And then, of course, my cell phone number is 904-707-9249.
Okay, and listeners, if you didn't catch that, you can always reach out to me on our webpage at fldeputyssheriffs.org, and we will post some of Robbie's information at the time that this podcast is published. So, Robbie, on behalf of our executive board, our president, and our listeners, thank you for coming on. I thank your sheriff for allowing you to come on. I know you have full-time responsibilities, and this is an ancillary thing that you do for us, and it's also your passion. So thank you so much for taking time out of your day and giving this important message. And I know that there'll be a time and a place where I'd like you to come back, because there's things that we didn't even scratch the surface on. So I'd like to have you back in the
I'd be
future.
happy to. Thank you again.
Thank you for listening to The Tactical Pause, the official podcast of the Florida Deputy Sheriffs Association. FDSA proudly serves over 25,000 deputy sheriffs across the state with legal benefits, vital training, and financial assistance in times of need. You can listen to previous episodes at fldeputyssheriffs.org or wherever you get your podcasts. If you've enjoyed the show, please leave us a review and encourage your friends, coworkers, and those in the law enforcement community to listen as well. To learn more about the Florida Deputy Sheriffs Association and how we serve those who serve, visit our website at fldeputyssheriffs.org.